In this week's update, what do seasonal patterns look like with the S&P? Precious metals marching on strongly, and the formula that works. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. Let's have a quick dash of overall perspective. We've got this continuing battle, which has been pretty much going on all year, between the poor fundamentals, all the reasons that the market should fall. And I won't go through them all. I mean, everyone's pretty familiar with what they are, from trade wars to the global lockdown. And on the other side, we've got this extraordinary wall of money that is in very heavy part, due to the actions of central banks and the enormous amount of stimulus. Now, the theory of what central banks were doing is putting money back into the economy, but it's impossible for central banks to be that targeted. And so what we've ended up with is an enormous amount of money that is just looking for a return. It's money looking to be used not to compensate for people having lost their jobs or businesses that are struggling. It's money that is really being used for speculative purposes. And so it's inevitable that some of that money is going to find its way into the market. But having said that, there is still an enormous amount of money on the sidelines, and I'll get back to that. So from my perspective, when you step back and look at the overall picture, it's reasonable to expect that this secular bull market, which is generally a 10-year plus event, will continue for many years to come. But remember that during this secular bull market that we're in at the moment, that we've already had two quite significant falls in the market. One in 2018 and another one just recently. So being in a secular bull market doesn't protect you from some very significant falls. And the one in February, March was nasty, as everybody knows. But it just means that there is a general, over a long period of time, there is a general upward movement in the market. Now, that overall upward trend is going to be interrupted by bursts of panic, both short-term and medium-term. We're going to see them, and we've already seen them in the last 2.5 weeks. Two events that have lasted just a single day before the market rebounds. So I'm sure we're going to see plenty of those. And we're going to see some that are going to run for weeks or possibly even months. But please remember two things. One is that the market in general is on an uptrend, and that the strongest stocks and strongest sectors are doing far better than that. So the important message is to get very targeted about what you're doing. We're not trading the market, we are trading specific stocks. So the mini panics for me that come along, be they one day, a week or 2 weeks, really present opportunities, particularly if you're focused on the right sort of stocks. So the reality is that there has never been a major market top when sentiment is as it is, and it's not good. Sentiment by the US Investors Association do a sentiment survey constantly, and sentiment is pretty poor. And there's also so much money on the sidelines. You just don't get major market tops when that occurs. Major market tops occur when everybody's all in, and there really is the marginal buyer has basically disappeared. So that's the reality of where we are at the moment. And according to the Savvy Investor, there's reportedly $4.6 trillion of money in the US sitting in cash. Now, not all of that is going to move into the market, but that is a absolute tsunami of cash. So if you're wondering why the market refuses to fall very much, other than for a relatively brief period like we saw in March, which was really all about, it was about perceptions really, and the perceptions have turned out to be wrong. It was perceptions and panic, and the global economy did not stop to the degree that the market indicated that it was going to. So let's look at American stocks. The S&P ended up declining 3.3% for the week. Most of that occurred on Friday night, so almost 3% of it on Friday night. And interestingly, it was led by the social media stocks. Facebook got really minced up. So did Twitter. And the financials really got hurt as well because of comments made by the Fed about the financials. Um, to me, this looks like just an overdue consolidation. The market has had an enormous rally, as everybody is aware, and this is just another consolidation period. Now, the index just slipped below 200, the 200 DMA on Friday night. It was only a minor amount. Whether that leads to further selling or not, remains to be seen. But there are many terrific setups coming into focus in the relevant sectors and with the relevant stocks. So I'm excited by the consolidation because it'll allow entry, high probability trading entries into very good stocks. Now, looking at the S&P index, there is some support just below where we are now, but there is a bit more meaningful support around about 5 to 6% lower than where the current market is. So I would expect that could be an area where we could see the market finding support and try to turn higher. The US dollar was higher again, up a little bit to 97.5, and the 10-year yield again for the umpteenth week in a row, steady at around about the 0.7% mark. Now, I just want to show you something before I move on. There's a lot made about seasonality in America, and people seem to live in fear about the June to September period. There's an old saying about sell in May and go away because it's, that part of the year is supposed to always be a disaster. But if you look at the seasonality, it's actually not true. A lot of people are fearful about October because, we've had the 87 crash and we've had some other quite significant negative moves in October. This chart here shows you the percentage of months in which the S&P closed higher than it opened. So in other words, it made a net gain. And I've got it set at the moment for the last 20 years. So that's from 2001 to 2020. And you can see that April and November on a long-term basis are two of the strongest months. April, May, and October is not too bad. November is good, and December's not too bad either. So that's on a 20-year basis. And across the middle of the year, you can see June tends to be the weaker month of the year, June and January. Just bear that in mind when I narrow this time frame in. And the July, August, September periods, around about 60% of those periods tend to be higher, finish higher. So it's not that much of a disaster. Now, let's wind this in a bit, and I want you to note two things. I want you to note the April and November peaks, and I also want you to look at June, because June is obviously the month that we've just been through, and the index appears as though it's going to be higher at this stage. So keep an eye on those, but also note the variability, which sort of really casts a bit of doubt on how valid this seasonality is and whether we should be concerned by it. So as I move this in, you can just see how things change. So you can see April and November seem to be consistently, no matter which time period you take it over, April and November seem to be particularly good years. But look at some of the July periods, particularly in the last 10 years. July can also be quite a strong month. And there we go. Look at the last 6 years. July has moved higher 100% of the time. And also June is still one of the lagging periods. But if we tighten it in quite a bit further, again you can see July 100% of the time has gone higher. So just in the last couple of years, we've seen this seasonality play out where April has just been consistently a very good month, no matter what time period you look after. So's November. And of late, we've seen July has actually been quite a positive month. So just an interesting bit of seasonality. The conclusion that I draw from it is don't worry about the seasonality to any great degree. And I think that old saying about sell in May and go away it just gets completely exploded by this chart. So I wouldn't be too swayed by those sort of the commentary that you might hear about seasonality. All right, this is the S&P now. So you can see that we've been in a consolidation. We had the big sell-off that occurred for one day on the 11th of June. We then recovered quite quickly. What had been support for the breakout turned into resistance, and the market has turned back down again. And I must admit there were some very significant volumes on Friday night, which in the short term points to further weakness. So it was not only the price falls of some of the stocks like Facebook and Amazon and Google, but they were pretty elevated volumes associated with them as well. So yeah, that's what we've got at the index level. But as I say, every single week, we don't trade the index, unless you've got your money just in an overall managed fund that spreads your money around across the board. We're trading individual stocks, so we really shouldn't be terribly concerned about what the index is doing. I think what the index does, it really just sets sentiment. People either feel good or don't feel good about the market. It affects sentiment, but that's about as far as it goes, in my opinion. Let's just look at the Nasdaq. So there's the S&P. So it was unable to regain the highs of February at this stage, and we've turned back down again. Now, if we look at where support comes in, if we put a Fibonacci scale on this rise since the bottom of the crash, then we get a level here at the 38.2% retracement, around about the 28.40 mark. It's quite possible we may also get some support at this level here, picking up these peaks from April and early May. So I think the likely zone where we will find support for the market, this is the zone here at the index level. But looking much more specifically at certain stocks to where support and reversal opportunities are setting up. Now, looking at the Nasdaq, you can see the Nasdaq has certainly exceeded the February high, and by quite a decent margin as well. So the Nasdaq stocks, the growth stocks, and yes, that does include the big technology stocks. They've definitely contributed to this, but they're not the only ones. So the growth technology stocks and the growth healthcare stocks, particularly in biotechnology, have been outperforming the rest of the US market by a very large degree. So that tells you something, right there in that chart. Let's look at the index, the currency, I should say, slightly higher on the US dollar, and that translated to slightly lower on the Australian dollar. So we seem to be back to just a currency, relative currency fluctuations. The Australian dollar got sold off during the crash, which normally happens. Then it's rebounded as though the crash didn't happen. And so we're still just basically now tracking along with a similar relationship to what we've had now between the US dollar for most of the last 12 to 13 months. Okay, while I'm here, let's just look at the ASX 200. So the ASX 200 was down just slightly, but one would expect the futures are certainly pointing to our index opening lower on Monday morning. So just to wrap up, Australian dollar steady 68.5. Our index lost 0.6, and particularly on Thursday and Friday, most stocks struggled a bit. There was plenty of profit taking. Most of it was fairly low volume stuff, so nothing really too much to be concerned about. There are some stocks that are rising, and it's always a very, very productive exercise to keep a watch on the stocks that are outperforming when the market is negative. And you often find some extremely profitable situations from that setup. Now, precious metals, gold rose again, so 2 big weeks in a row, finished up $28 at $17.71, so it broke the $17.50 level and is charging towards $1800, as we'll see. That translates to an Australian dollar gold price of $25.85, nearly $2,600. Most of the Australian miners have got an all-in sustaining cost somewhere between 1,100 and around 1,300 Australian dollars an ounce. So that gives them an enormous profit margin, and they're doing extremely well. And to my mind, the market is not really reflecting that growth in earnings that's coming in the pipeline. Now, looking at precious metal stocks, GDX another strong week, so it's the second strong week in succession, bouncing off the breakout support. But gold miners are still, and this is really talking about the major gold miners. So GDX reflects the top gold miners in the world. It doesn't give you a cross section. It's the Barricks and the Newmonts and the Newcrests and those sort of major gold stocks. The earnings growth for smaller and medium tier stocks is going to be even more marked. But at the major stock level, gold stocks are still underperforming the metal if you look at the GDX to GLD ratios. So GDX obviously reflects the stocks, and GLD is the ETF that tracks the gold price. So we'll take a look at that ratio, because that is really quite interesting from a long-term point of view. And as well as underperforming the metal, so that we've got some long-term catch-up yet to occur, stocks are also extremely cheap. If you look at their earnings growth rate, some of the numbers that I'm seeing coming through now indicate that we could see earnings growth in the majors between 50 and 100% quarter on quarter and year on year. So when you compare that sort of earnings growth rate to their current valuations, they really do look very cheap. So the stage is set really for gold stocks to do some sort of catch up. Now, the only thing we don't know is exactly when that's going to happen, but that mean reversion is a very high probability event. So let's look first of all at gold, and this is on a daily chart, so you can see there's quite a nice uptrend going there, and we did have an ascending triangle there, so formed by these highs and these higher lows, and now we've had a breakout above that 1750 level. So that was the important level to overcome. It's done it, and now if we pan back and look at the weekly, you can see that we're heading towards this major top, which occurred in 2012. The all-time high was in September of 2011, and that's just over 1900. But 1800 will be an important level to break. And if you look at the steepness of this channel, it doesn't look like it's going to take very long to get there. Now, that channel at the moment is about $150 wide from top to bottom. So this allows still a fair amount of fluctuation. So don't go overboard with precious metals and precious metal stocks, because there is still the capacity for quite a bit of fluctuation. And if the gold price were to come back down to this lower boundary and do it quickly, then that's quite a significant fall. You know, that could represent a $100 fall in very quick order. So just remember the volatility around precious metal stocks. But there's no question, you can't argue with the trend. This is a very, very powerful trend. Now let's just check in on silver. So silver still, it started to catch up a bit, started to outperform gold, but that's now stopped again. So the silver price still needs to do quite a lot of work to catch up to gold. Now I'll look at GDX quickly. So here's GDX. This is a weekly chart with major base going back to 2013. We got a breakout about 6 or 7 weeks ago. We've come back, we've retested the breakout, and now 2 very strong weeks in succession. And the other key point from a fundamental manager's point of view is that look at the relative outperformance compared to the S&P. And this is what US funds, US mutual funds focus on so much. is the relative performance to the S&P. They can't afford not to be in sectors that are outperforming, and clearly the gold miners are. Now, just one final thing I want to I want to look at. This is the spread between GDX and GLD. So this is GDX divided by the gold price. Now, I did say that that ratio is still underperforming. You might look at this and say, well, what the heck's he talking about? You know, that looks to be outperforming very significantly. And over the last, let's say from the crash, it has outperformed. But my contention is that the crash in equities, in commodities, was a short-term panic event that has effectively now been reversed. Prices have pretty much gone back to where they were. And so to a degree, you can almost sort of ignore that as being just a very short-term aberration. But if we start to pan back, you start to see a much bigger picture with this relativity between the value of gold stocks and the value of gold itself. So if we go all the way back to 2006, which is when this ratio started, then you can see that it used to be up around about the 0.66 level and went into a long-term decline. So back when there was a lot more enthusiasm for gold stocks, gold price had just come out of a 20 to 30 year bear market in the early 2000s. The gold price had started moving up. Gold stocks responded very positively, and you can see the result. The ratio between gold stocks and gold was far more buoyant than it is now. Now, we've been in a big basing formation since 2013 in respect to this ratio. And yes, in the very short term, we've done some catch up, but that's really just brought it back into the range that it's been in for quite some time. So to me, just ignore this little bit here. So we are still in an overall base, and on a big picture level, there is still a huge amount of mean reversion potential for gold stocks to catch up to gold. And then if you consider how steeply the gold price is moving, so let's just look at the gold price. Just a reminder again, so the gold price is moving up very steeply, and gold stocks have an enormous amount of catch up in terms of their relativity to the gold price. You can see just how much potential there is in gold stocks over the next 6, 12, 24 months. All right, that's precious metals. Commodities, copper, higher again. And really the 28% plunge that we saw during the crash with pretty much all commodities to varying degrees, that happened in the futures market. It didn't really happen in the real world. And so we've had this panic-driven dip, and now we've had this recovery, which has pretty much brought it back to where it was before the crash. So the plunge was about perceptions and about poor conclusions. And this is something to remember on a wider scale for equities. You know, don't always overreact to sudden price moves, because often they're just about the wrong conclusions, and they're not actually about reality. So it always serves to understand what is driving these prices. Now, West Texas Intermediate crude was down, gave up about $1.30. And that was because inventories went up. Production's being ramped up in the US after about 11 or 12 weeks of declining production. That turned around, and so we're starting to see higher inventory levels. So for me, the energy sector is just all too hard at the moment. It's too unpredictable, and it's a sector to be avoided. There's the spot copper chart, so you can see we've basically come back up to where we were. The market was trading between 260 and 280. The crash was a bit of an aberration, and now we're back into that range where we were before. So just to wrap it up, the formula for success for me, and I just keep harping about this every week, is quite straightforward. Why try and be in everything? You know, why be diversified? Why try and manage risk by diversification when that means, that implies that you are going to own some good stocks, you're going to own some medium stocks, and you're going to own some poor stocks. Why would you do that? Why would you deliberately own poor quality stocks? Why wouldn't you just narrow your field of vision to the sectors that have got unquestionable growth, no matter who's in the White House, no matter what the central banks are doing, no matter what the trade war with China is doing, these sectors are going to grow, and they're not that difficult to identify. Then once you've identified those sectors, then find high quality growth businesses within those sectors. If you don't know how to do that, then you need some assistance with it. But you need to understand what are the sectors that have got the tailwinds, what are the stocks that are going to have unquestionable tailwinds, because then it just becomes a matter of using technical analysis to guide entries and trade management. This just requires clarity. It's quite straightforward. It's not easy to do because there's a lot of work goes into identifying those high quality businesses, and a lot of experience needs to come into play to be able to read the charts effectively. But it is quite a straightforward process, and it is quite different to the process that that most people will follow. So that's the formula. Portfolio analyst this week is really just identifying the high probability setups, and there are quite a lot of them coming into focus. So that's it for this week. There is more information on the website, and there's my email address for anyone that wants to get in touch with me. That's it for this week. Cheers.